Hi, Peter Jones, Chartered Surveyor, author and property investor, and in this, the 11th video of our 12 video series, we're thinking about what are the tax implications of owning property and my property business. Well, to some extent we've already covered this in part in some of the other videos, but essentially what we need to be thinking about right from day one is how we do mitigate tax. Now, I'm not against paying tax, we all need to pay some tax, but we don't want to pay more tax than we have to, and there's going to be ways and means of helping us to do that. Now, one thing, just which is a bit of a summary, is Clause 24, or Section 24 as it's sometimes known, of the Finance Act 2015 now restricts the amount of mortgage interest that we can offset against our rent when we're calculating profit for tax purposes, and by 2020-2021 we won't be able to offset any interest against our rent. So the tax implications on that are pretty huge, which is why in an earlier video I was suggesting that 99% of investors are now thinking about putting their properties, buying new properties, putting their old properties if they can into a limited company, and that's probably a very sensible move for tax purposes. Here's another thing. I also said in the last video that an exit strategy for us could be death. If that's the case, then we need to be thinking about inheritance tax. How can we mitigate our inheritance tax? Well, one way of mitigating inheritance tax is to finance against our properties regularly. Now, I hear a lot of investors saying to me that they want to pay down the mortgages on their properties as if that's some kind of virtuous thing. Thing is, if you end up with a large portfolio which is completely mortgage free, you're leaving your estate a large tax bill. Would it not be better to finance those properties when you can? Take the money out, and yes, you can blow it and enjoy it. As long as you're not putting the structure at risk. If you've got them all in a property company, for example, you don't want to put the property company at risk. But if there's enough equity that you can spare some for yourself, then by taking the money out and effectively using it as disposable income, then you will be reducing your inheritance tax bill when you eventually go. And by the way, because you can't pull out 100%, you'll be leaving some for your heirs as well, so you needn't feel guilty about that. Now, I'm not saying that's necessarily right for you. You need to think about what's right for you, but that's certainly something which I know some investors do. They refinance, they spend the money because it's effectively disposable income for them, and then they're reducing their inheritance tax bill. Of course, the answer is, how are we going to make sure we mitigate tax? Well, we're going to talk to a good property accountant. There are good property accountants out there. Part of your role as a property investor is to go and find them and to talk this stuff through. But if you want to read some books about property tax, I can recommend a couple. Ian Wallace, you'll find him on Amazon, all about property taxes. There's also Carl Bayliss as well. Go to taxcafe.co.uk, or is it taxcafe.com? Can never remember. They do a series of really good books about property tax as well. So the information's out there, and talk to a great property accountant. Hope that helps. Here's to successful property investing. See you soon.